the market has been very choppy lately. It's been a very big push-pull, and it's not really following. There's no real follow-through, both to the upside and to the downside. You get these sharp liquidation breaks down and sharp short covering rallies to the upside, and then the next day you're expecting either a follow-through on the breakdown or expecting a follow-through on the upside, and you get nothing. So to me, this is just a matter of day traders going back and forth, and as well as algorithms pinging the levels. And I believe that this type of movement, yes, whipsawing, causes what's known as trader fatigue, and that eventually can resolve lower. So we have to be a little bit careful with that if we chop around a little too much. The one saving grace, though, is I believe that this is all just sort of anticipation into the Fed decision, which we know is December 16th. And what I've noticed is that I think that some of the selling has been a lot of institutions just taking down their value at risk because no one really knows what's going to happen with the Fed with regard to the rate hike. If the market, first of all, what the Fed is going to do, if they're going to hike or not, and then two, what the market reaction will be up and down or down. So that's why you watch me, to get that information. So my thoughts on this are as follows, and I'm going to get to it at a little bit of a. I'm going to build up to it. I'm going to explain why I think what I'm thinking. So there are 6 keys that the Fed looks at, and there being the 7th with an asterisk, because it's one that will never be mentioned, and we'll cover that in a moment. So they first look at the jobs numbers. We know that the non-farm payroll, the unemployment number, was quote-unquote good by the media, except the pace of wage growth was kind of it inched up a little, but it's been kind of junky for a while. And we also know the quality of the jobs aren't that great. And yes, the labor participation rate has been weak as well. I posted today that we were talking about Men's Warehouse reported. They sell the suits. And I think a lot of the problem that Men's Warehouse is having is because of unemployment. If people are getting jobs in the service industry as bartenders, waitresses, over the summer, I think it was carnival ride operators, these people aren't buying suits. They're not going on interviews. They're not going to jobs. They're not. So that to me was proof, a complete indictment that the jobs numbers aren't good. As crazy as that sounds, that to me is actually the case. So we know the jobs numbers aren't that great. Yellen has mentioned that she realizes that the headline number isn't as good. Even Bernanke admitted this, that the headline number isn't as good as they make it out to be. And I know the media, no matter what that number is, the media is on this like hell-bent to try to influence the Fed to hike rates. I guess they need, the ratings are down, they need a story. So my take is that the jobs numbers I think they're abysmal, but I'm willing to say that they're like, okay, they're not as good as people are making them out to be, but they are, they're not necessarily super atrocious. They're kind of just stall speed. Note that term, stall speed. That is very important. GDP. So the gross domestic product. The Atlanta Fed, we know, lowered their GDP estimates for the fourth quarter. They had been, I think they were 1.9%. They had been revised up to 2.3% and then revised back down to 1.4%. So that's pretty junky. That is below 2%. The Fed has talked about wanting to have an inflation rate of 2%, and they don't even have a GDP of 2%. So no good there. The Fed has, by the way, talked about reaching their 2% inflation target and cited that they're not going to reach it until 2018. In the previous video, I have said that the Fed, to get to that number, should... I did it as if you were... I think the example I gave was driving to the Hamptons. We know it takes 3.5 hours. If you want to cut that down into an hour and a half, you press the accelerator down. You don't take your foot off the gas. If you take your foot off the gas, you're going to get there slower. You put your foot down, you get there quicker. The way to put your foot down is more QE. So that to me makes no sense. If they're not, if they're not going to reach their hypothetical inflation 2% target, 3 years from now, or now, I'm sorry, it's going to be now 2 years from now, what are they doing raising rates here? It makes no sense. There's a lot of runway between here and there. ISM, both the service, first of all, the industrial one came out. It was a recessionary number below 50%, and then everyone was going to hang their hat on the service one being good, and then that was below 50%. So you have both ISMs junky, so not good. PMI also recessionary, negative, below 50. Durable goods orders were okay because of there's a boom in aircraft, and we all know auto sales have been okay. Keep in mind, though, that auto sales and housing, which are kind of the engines, I guess, of the economy right now, are very interest rate sensitive. You start raising interest rates, those sales are going to plummet. So you're kind of kick the legs out of the stool that's holding you up. Seems really smart to me. So durable goods, we're going to say that they're okay with a caveat of them not really being okay. The dollar is also a very important input here. We know a lot of companies do business overseas, and they need to repatriate that money, and if the dollar keeps surging, it makes our goods less attractive to foreign buyers. Very big problem. So the dollar has backed off a lot. It was hovering around 100. It has backed off, and I think a lot of people were saying, Draghi came out and he did more QE. The ECB, by the way, is doing QE, as are the Asian countries, and now we're talking about going the opposite way and doing hiking here while they're easing there. That will only exacerbate the strength of the dollar. So Draghi had come out and he had said that they weren't going to do they were comfortable with what they were doing. They were going to, I guess, just keep the QE at the current level. They weren't going to increase it, and the market didn't like that. It had already baked in that he was going to raise the amount of QE, and then we had that sell-off, and there was a huge spike in the euro and a big sell-off in the dollar, and a lot of people were saying, that's going to give Yellen cover to hike. Then the next day, Draghi came out and clarified his statement, and the guy who was questioning him kind of sounded like something I would have said to him. Are you making these statements to clarify, your statement? And Draghi goes, no, and then there's a pause, and he goes, of course. So he admitted that he didn't like the market reaction, and he wanted to talk the euro down still further. So the dollar, of course, had a bit of a rally. It didn't get all of it back, but it's still hovering at a very dangerous level. The seventh input, and you will never, ever, ever hear this spoken by the Fed, is the S&P 500. They watch it. They could say they don't. That is total horse hockey. If you have a big move down in the market ahead of the Fed number, they are going to be less likely to hike. Right now, it's not really down enough, but it's teetering. We're at a very, very funny place in the market. I'm going to talk about the SPY levels in a moment, but the S&P is also a very key linchpin. Just like Draghi, he didn't like the reaction in the market. He came back and he did his of course. Yellen may have to have her of course moment, and I'll tell you, markets are very good at making people do things they don't want to do. And I do believe that the Fed wants to hike interest rates. That's really their only play here. At least that's what they think. They're really play what they should be doing, in my opinion, is waiting to see what the fourth quarter data was. We know we have an abortion for a holiday season. The weather is too warm. You have tons of jackets sitting in empty stores. I went to Bloomingdale's the other day. I got a bunch of stuff 30, 40, 50% off. I got a really cool pair of shoes, 50% off. And the store wasn't really that busy. I believe that we should see what the fourth quarter looks like. And the last 2 years, we have had very, very weak first quarters. I believe some of that has been attributed to the super cold weather we've had, which might not be the problem here, but I don't know that that's the case. If I were the Fed, and I'm not, I would wait to see what the fourth quarter and the first quarter look like, and then around March, make the determination. If it's still weak like that, you see the first quarter, then by that summer, if there isn't an improvement, then maybe they want to do some more QE. We'll have to see about that. They're talking about the interest rate hikes. So my view is that they should not raise interest rates. They should not. The data, if they are truly data dependent, the data is showing weakness and deflation. All you have to do to pull up to the ultimate arbiter of deflation is gold, oil, copper, you name the commodity, it's going down. It's almost like a straight line down. Today you had new lows in oil. The Fed did cite that they do see 2016 as the commodity pressure alleviating, and they were talking again. What amazes to me, these people in the ivory tower, is that they keep talking about theoretical inflation, about possibly this happening and possibly that happening, and of course everything is always transitory. But you don't have hypothetical inflation here, you have very real deflation, and you're going to see just how bad that deflation can get if you start raising interest rates. So part of the reason the market is trading as high as it is because we are at historically low interest rates. We are at unprecedented historically low interest rates in what's considered emergency policy. I've heard a lot of people say that we're not in an emergency anymore and we don't need emergency policy measures. Okay, I'll grant you that. But the time to have hiked was when things were on an upswing in 2013 when the stock market was up 30%. We're now 2 years later, things have slowed, the cycle is sort of bending back over. You have what I believe to be structural unemployment. You go into these restaurants, by the way, you want to talk about, so I went into Pizzeria Uno a few months ago, and they had a box, like an iPad almost, on the table, and you can place your order through that. So all these service industry jobs that are, the waiters and waitresses, they're going to be on the bread line soon too, on the unemployment lines, not buying men's warehouse suits. Anyhow, that's my take. They should not be raising. Now, that doesn't mean that they won't. There is room for a policy mistake. For some reason, it seems like a lot of these Fed governors have it in their head that they need to hike interest rates. Maybe it's some kind of a macho thing. I mean, I have no idea what these people are looking at. Honestly, I've just told you what they're supposed to be looking at, what I look at, what I know the Fed looks at. But they have they're academics. They have these rose-colored glasses on. They have been very, very smart up till now. I believe a lot of the tough talk, is known as moral suasion. They're trying to keep the markets cool. They don't want to have a blow-off like they had in China and then a crash and then they're forced to go into action. I believe that they're just trying to cool things off a little bit. If I'm wrong on that and they do start hiking, that is going to be very bad. Think about it like this. Discount rates, discounted cash flows, that's how stocks are really valued. I don't want to get into valuation. If you're curious, just Google the DCF method. There's two ways to value stocks. There's a the dividend method, the dividend cash flow, or the proper way is the discounted cash flow. So you could Google DCF or discounted cash flow, and the formulas are in there. The divider, I'm just going to cut into this, is known as the weighted average cost of capital, the WACC. And as the risk-free rate goes up, the amount that you have to divide the top number by, which is your price, by your PE multiples, that is going to get cut as your denominator goes higher. The numerator we know is what it is. As the denominator goes higher, the end product gets less, and that is your PE multiple. So the PE multiple stays high as long as interest rates are low, and the PE multiple contracts when interest rates go higher. That's because bonds start becoming a viable alternative to stocks, and that's why when you get interest rates up to 5 and 6%, that's usually when you get your crashes, because people just load up into the bonds. So my theory is this. So how do we trade this? What's the actionable play here? If the market rallies into the Fed, the play is probably short. If the market sells off steeply into the Fed, the play is likely long. It depends on where we are. If they do something silly, like just gun this thing up into the Fed, it's going to be trouble. The real dilemma is if we go sideways. Then the answer is we sort of have to wait and see. There is nothing wrong with being the second mouse here. The first mouse could get his head snapped, and then you'd be the second one. The best way to play this, and the way that I think is the safest, is to just forget what people think and just go by the levels. And I have very pinpoint accurate S&P levels, particularly in the SPY. I know a lot of people trade SPY, so I usually focus in on the SPY. And I'm going to review those levels with you now. Let me pull this up. Let's go to I think 9 months should be enough. So here we go. I'm just going to go through, I can't show you the visual representation, so I'm just going to talk through this quickly. We have a rally that has basically gotten very close to the old highs. We have rallied enough here, though, that this could be a significant lower high, and the market could really collapse into a big rounded top, and this could be the kind of the end of the bull market. That is a very, very real risk. And if that happens, we should know rather quickly, because there'll be certain levels that are violated. So far on this pullback, we've held the levels that we needed to. We had the peak of the last leg that was on 11.3. We pulled back. We stopped just shy of 201.90. That is very, oh, hello from Ukraine, very cool. We held that 201.90. That was an old high, and we rallied. We tried to get above the 208.97, very key level for the market. That's sort of the ultimate arbiter, in my opinion. There's a very high volume node up around there. It's a little bit higher. It's around 209, in the 209s. But we consolidated around there. Then what was interesting was on 12/1, on December 1st, you seemingly had a breakout of the pattern up. Followed the next day by a look above and fail and close with a bar below the low. That's a very, very crappy pattern. That's the danger. You don't want to see that. And then the next day there was follow through lower. I think everyone got excited and thought the play was short. And then the next day, of course, we were up huge. Completely, it was a gap and go. Completely took out that bar, closed strong. Then the next day was kind of iffy, but down, and now we're lower. So it's just this back and forth whipsaw. And the danger is that a lot of increased volatility at the top or the low of range can sometimes be the top or the bottom. The market doesn't usually top in a day in a blaze of glory. It sometimes happens over time. And my big fear, and I've mentioned this in previous videos, and I'll show you this on Sunday, I'm going to go over this in more detail to really show you the chart, is that the market is in a big cresting pattern and it could have the rollover. That does not have to happen. If the Fed does the right thing, if the Fed stays accommodative, we'll be okay. Let's go over some of those levels. Right now, yesterday, not today, we held the 204.12. We stopped, I think, was it just shy of it or right to the tick? Let's see. 204.18, I've discussed that. That's sort of the lower end of the range where the real correction, the big 1,000-point crash or whatever, that's really, once we broke those lows, that's really when this really got started. The Friday of that day closed below there, and then we know what happened the next 2 days. It was just a complete free fall. So we held the low. That's really the lower end of the upper distribution of prices. It's good that we held that yesterday. Today's bounce was looking better. It didn't end so well. If we lose that area, 201.90 is very important. If that area is lost, we are in more trouble, I think, than people are going to want to admit to. We're then talking about Fibonacci levels. The 50% is the 199, the 61.8 is 196.38, and then there's a big gap fill around 195. I discussed today that I put on a put ratio for next week, 198, 195. I got it on for like 5 cents credit. It's a bit of a flyer. I don't know, which I didn't have to pay for. I got my credit, so that more than ate the cost of the trade. So if we get down to that 195, that gap fill, I do believe that would be so far, so fast, that would be a buy. However, I'm looking to do something maybe somewhere around the 200 level, somewhere around 202 to 200. That's a big number. We know we have a big December expiration. I believe there's a lot of high open interest over there in SPY. Let me just pull that up. let's see, volume, open interest. The 200, not surprisingly, is the highest there, and then 195, which is good, is the next highest. I fully expect those numbers to change a little between now and then, but I do believe that December expiration is a biggie. That's also a quarterly expiration, so it's a monthly and quarterly expiration. I believe that that area should hold, and there'll be some options that kind of, I guess, we'll have to see. Like I said right before, I sort of like to fire with those right at the whites of the eyes, but I'll be looking to play something around there, and if you're following me on Twitter, I will tweet out the trade. So that covers, I think, the Fed. Like I said, a lot of this weakness, I think, is just institutions taking down their value at risk, VAR, just meaning they don't want to have as much exposure. People tend to get small when they don't know what they're doing. I think they're talking about acronyms, VAR. I think they're afraid that the market's going to become like some kind of SVU, Special Victims Unit. So that, I think, is what's been driving it. A lot of the weakness has also been tied at any given point. I talk about there are 6 market keys. I just talked about the 6 Fed keys. The 6 market keys are the VIX, the dollar. I've been talking about the UUP, the bonds, which is I do TLT, oil via USO, China via FXI, and then, of course, the IBB, which is kind of a risk barometer. At any given point, at any given day, one of those can take over. And the one that has been taking over there are 2. Is the bonds, and really more lately is the oil. So I believe, and I want to just point out, at the top, when oil was peaking, the algos were keyed into oil. As oil went higher, the market went lower. As the oil went lower, the market went higher. We are keying on the oil again here now, down near the lows. I don't know that we're at the dead low, but I think we're getting close. 37 was a key level. We're a little through there. And then 33.20, I believe, was the 2009 crash low. That's very key. I don't know if we're going to bounce, to the T or whatever, but I would say that we're probably closer to a low in oil than we are the high in oil. I've talked about it. I think that it's trying to search for a bottom. The Saudis are just pumping, trying to steal market share. They're trying to punish some of their neighbors. It seems as though OPEC is kind of broken down. That semblance has been sending price lower. You have a lot of levered plays. We saw the dividend cut in Kinder Morgan, the same thing in Freeport-McMoRan. I just want to say in 2009, when Freeport-McMoRan cut their dividend to 0, that was the bottom. That was the dead low. That was where you had to buy. Not sure that that's the case here, but Carl Icahn seems to be buying. He just upped his stake recently. Some of these smart guys have just been loading up onto these types of trades. There's something new I want to introduce to you guys that we haven't talked about before in previous videos, and that is the high yield problem via the JNK, which is the junk JNK. And then there's also, someone had mentioned to me, the HYG, that's the corporate bonds. These are not pretty charts, and this could be a big problem. A lot of companies, I don't think that the leverage in the system is nearly what it was at the peak, but these charts are not going the right way. They're going lower, and this can be this could be a real problem for stocks going forward. I don't know that we're at crisis levels yet, because I think people still believe in the Fed the backdrop. But if we start really, if they start ramping rates, this could get real ugly, really quickly. Amazingly, if you go back on, let's say a 20-year monthly chart, the low in the, let's just talk about the HYG, was 61.5. We're still in the 80s, and we're not even at a Fibonacci retracement from the low to the recent high. The 50% fib there would be 78.90, and the 61.8 is 74.79. There's a reference low from the, the debt ceiling fiasco, which was 77.90. And then there's another reference low from a little further back, which would be actually the 50% fib. So I believe that there is some room a little lower in there, but it may be due for a bit of a bounce soon. However, like I said, rolling over. When debt rolls over, the bond guys are always smarter than the equity guys, and if they're in a bit of a tizzy, it's only a matter of time until that bleeds into the stock market, because stocks are very liquid and they can be sold pretty quickly. Some other things that I've noticed that are concerning to me. The big danger, I think, is a lot of people are piled into these FANG stocks. That's the Facebook, the Amazon, the Netflix, and Google. I will never call Google Alphabet. You'll have to, it's like, pry it out of my cold, dead hand type of thing. I will never stop calling it Google. It's always Google. Maybe I would change if they change the ticker symbol. I'll relent if they change the ticker symbol. Until then, I still call Altria Philip Morris, Mo. So I guess I'm old school like that. Anyway, my big fear with those stocks are that they've run a lot and that funds will need to lock them in to pay out their bonuses. If you're still long the stock, you haven't realized it into cash, and there could be some type of a lock-in on those stocks. A lock-in means lower prices. It means they will sell off. Also, if the market gets funky, those are big stocks where people have a lot of gains. They're high dollar price stocks that are very easy to sell. And eventually, Gresham's Law, the weak bring down the strong. Very simple. Be very careful with those stocks. Facebook in particular, I wanted to talk about with you guys. I know a lot of people are long that via shares. I promised I would talk about a hedging strategy. That was a little bit of a tease for me to get you guys interested in today's broadcast. So let's talk about it. If you were following me last February, I did a similar trade with Facebook. My concern with Facebook is that we got, first of all, let's talk about where we are with regard to Facebook. My concern is that we got the 1.618 Fibonacci extension. We actually got a little bit above it, and we are in a bit of a consolidation period. This box is very similar to what happened in, this was July, I think. July to, I guess to August. Yeah, July to August. We had that consolidation, and it's looking very similarly where we have, one day up, one day down, or, 2 days up and then 2-3 days down. So what I would suggest doing is the following. I would do a synthetic fly. And what does that mean? Or I would do some type of a diagonal, and I'm going to talk about both ways to play this. So let me just take a swig of water because this is going to be long-winded. Basically what that means is if you own stock, you want to sell a call that's either right at the money or right near the money, and then take some of those profits and buy calls that are still higher. What does that mean? Let's just pull it up. I didn't really rehearse this ahead of time. Probably should have had one, but let's do it live. How's that? So if you're long Facebook, for next week's expiration, the expected move is just under $4. So what I would suggest doing is you can book about half of that right now if you want. You could sell the 106 call. It's trading. Let me just get the Greeks up here. Very good. Let's pull up the mark. You would sell that at, let's say, at the money. It's $1.43 now. I'd probably look to get $1.50. And then I would take that $1.50 and you could buy like the 110 calls with that above if you want. And you would, those are 30 cents. So you would pocket the difference. If the stock goes down, you have that as your buffer. You have a amount of money as your buffer. If the stock rallies, you might lose your shares. But keep in mind, you're losing it plus the premium. So you're basic, and you're still getting the amount of the call you're long. It'll be a fraction of it, but you'd at least participate in some of the upside. The better trade, what I would like to do with this, is sell that at the money call or that just out of the money call, take that premium, and then go out a little while. Take it and go out to January, and then use that to buy maybe a 110 call if you want. Or you could wait for the rally. You have that premium. That premium is in your pocket. You could use it to buy a call later on. I tend to like to put these trades on at the same time. Once in a while, I'll close these types of trades individually or put them on in piecemeal, but I have a lot of experience with this. If you don't, don't mess around. So I would do it like that. Like I said, sell the 106 and then maybe buy the 110 if you want to play, or the maybe the 109. That was a lot of resistance if you're doing it in the weekly. I would like to do it more like this, where I would sell that 106 and then buy the monthly for January, buy the 110. So even if you're taken out with it, what's this? The best way to get into option trade. It's funny. Let me talk about that in a minute. Let me just finish this thought with this. Somebody was asking about the best way to get into trading options for beginners. We'll do that right after this. So like I said, I would like to sell the more close dated, because we know we're in this consolidation period, and I would use that to buy the longer dated call. And then what would I do with the shares? I would put my stop just below the floor, so that you don't have the share risk. If you do it the way that I had suggested initially with the synthetic fly, a regular call fly is you buy a call, you sell calls, and then you buy them up high. In this instance, you're owning the stock, so it's synthesized by that way. You're selling at the money and then buying further out of the money. You could use the difference in the premium as a stop below the floor. So if you break it, you could use that as a kind of a buffer, or you can just use the stop out, and then you have you have your dollar and change. So that would be how I would do it. The two ways: the synthetic call fly or the diagonal, selling the at the money or just out of the money call to buy a longer dated call. Another option, this is a little bit more advanced. I'm a little hesitant to mention this. I could tease you guys and put it into the weekend review, but I'm going to be a benevolent dictator and just do it this way. If you want to lever your bet on Facebook to the upside, if you're a real, if you believe that there's going to be a rush into these stocks and it's going to re-challenge the high, let's just use simple, a 1x2. So you could do a 10x20, whatever. So what you would do is, let's say you own 100 shares of Facebook. Let's keep it simple. You would buy an at the money call, and then you would sell 2 times out of the money as many calls as you buy to finance the price of the call. The idea is to get it on either for a slim credit or for break even. And then you would benefit from being kind of doubled up. This is kind of known as share repair or share enhancement, and you would be able to use this to kind of lever your bet to the upside. So yes, you're short too many calls, right? 2 times, but you own a call and you have the stock, so you would be called out of it, but you would benefit from the extra bump from having that leverage from the option you're long, if that makes sense. So those are 3 really, I wouldn't say they're really advanced trades, but they're probably intermediate advanced. I could blow you guys' minds with some really insane stuff right now, but I really don't want to do that. I think it would get a little too complicated, and we've covered a lot. So let's leave it at that. I get the information. The Greeks, if you just go into TOS, they have a layout, and I just do the delta, gamma, theta, and vega, and then that gives you the Greeks. And then what I do is I sometimes change one of the columns into mark, and I use that when I construct these trades. I used to use the theoretical, but it was giving me problems, so I just used the mark. So that covers Facebook. Let's talk about Twitter quickly, because we like to talk about Twitter sometimes when we talk about Facebook. I don't know why. The Twitter is not even close to as good of a company or stock as Facebook, but something happened today in Twitter that has me a little bit interested in it. It has a secure low in place. What is a secure low? It is a low, usually accentuated by a hammer, bookended by 2 higher lows. Look back to the prior 4 days in Twitter. Today broke the pattern up, but the day before was a higher low than the previous, and the day before that was higher than the previous, all with hammers. That is a great long opportunity. I think a lot of the pressure on Twitter the last few days has just been tax loss selling, people who are buried in this thing. Why else would you sell it now? The earnings are far off. Anyway, the good news about Twitter is it closed at 25.90. I really would have liked to have seen it in the 26s, which was the IPO. But the good news is 25.90. It was basically an equal close to the kind of the high before the breakdown. You've now engulfed 1, 2, 3, 4, 5, basically 4 or 5 days worth of trading with one bar. If you're long, you can play here. Let's just keep it real simple. You could use a 20 MA stop, or you could use 25 to 24.90. Anywhere below that 24.90 to me is really suspect, and the trade is no good. But I think you can be long a little Twitter here. My fear here is that it could be forming a bit of a head and shoulders, but if you use those levels as a stop, you won't get caught in the real teeth of a decline. Anyway, that's my take on Twitter. If it were to rally, maybe you get back up to the 50 MA, or one of the fibs. I'll discuss that a little bit more because that's a little bit more visual. I'm going to do that in the Sunday video. Just trust me on that. Some other things I've been watching. One thing that could be a sign of a market top is when you start getting really big M&A. We had the DuPont and Dow Chemical. They have a lot of cost synergies. Out of the two, the Dow has the better chart than DuPont. So if you want to kind of play that, I like put ratios in that, meaning you buy one put and then sell times two times as many lower. I would love it if it was coming down and to play that for the gap fill. That would be amazing. But you would need really the stock to start to go down because you're net short premium, so you need the IV to kind of pop. Chipotle, let's talk about Chipotle for a minute. I talked about this the other day. I was noticing, and I had talked in the weekend review that I was looking for this thing to go into the 400s. Sometimes I have to call an audible when things change. You know, a lot of people like to be right. You can't first be right until you first stop being wrong. I still think it can get into the 4s, but it might not happen immediately. A lot of the problems that I find newer traders, and I have to confess, I sometimes find myself making the same mistake. I just assume end range immediately. You know, it broke this level, it broke the 580, so naturally we're going to go completely all the way down. People who are who are already long this are not going to just give you $100 more downside just so you can get a better entry. There are stages of rigor mortis, so to speak. Anyway, the stock wasn't breaking down a lot. It was sort of hitting around the 515. I noticed another report came out, and the stock was only down like $8 or $9. That's nothing for a stock like Chipotle. The stock's $500. If you're short now, think about this. Let's get into the trading psychology of what was going on in these people's minds. The stock is down from $758, and it was down, you're down basically over 200 points in the stock already. So this isn't like a new story that Chipotle has been weak. There's been a lot of selling already. You're actually at some pretty big Fibonacci levels. Already you had responded off the 61.8. Part of my short thesis, if you remember, the break of the 580 was the violation of the 61.8 and the violation of that low, and that was a big cascade. It did rally up, and then it took out that low, and now we're kind of getting back to where the retest was. My thought was, is if you're short, and a lot of people piled into this late, a lot of people, the same schmucks probably who were chasing this up at 758 were probably loading up on puts already on the lows. The IV was high, and they had to be right immediately, and they weren't. They were not getting follow-through. You get a piece of information like that comes out that should tank the stock, and that really should have banged it hard, and it's down $8. You've got to be thinking you're not getting rewarded. You got to get out of this thing, and then you had the squeeze higher. I took that opportunity. I went out over like $90 or $100, and I sold 450 puts. I think I got like $1.30 for them, and I haven't closed them yet. Although I'm sure I should soon. They closed under $24 cents today, so that's over $1 in profit, and there's 8 days to go. And the theta, at the time I think it was a 5 delta. The delta on it is like nothing. I think it's a penny. And the gamma, which is my kind of first derivative of delta, is 0. So this thing would have to they would have to like burn the business down, in my opinion, to get there by next week. Anyway, I was debating, and here's the dilemma I was debating today. What do I do with this now? I'm obviously going to close these at some point. But I was thinking about rolling them to January, and then I said, Now you're playing really directionally as opposed to just playing with volatility, and I opted to do nothing. I'll wait until this thing comes down a little if I want to play that way. So that's Chipotle. If Chipotle, so the CEO came out, the co-CEO came out today, and he basically said that they, it sounded to me like they probably had something bad from a supplier, and that's done. It's through the system. They don't know what it was yet, but they haven't had new instances, and they have all kinds of new screening implementations. It's probably the worst of it is over. At this point, if there's something else comes out, the stock will probably get nailed again. Let's see how it handles a pullback. We're into some resistance here. We're not through the 580. We're close enough for government work, in my opinion here. I basically got the move I was looking for, and I'm not going to press that bet. When I was younger, I would have rolled that thing in 2 seconds and rolled the dice, and I'd have 36 more days now to sweat it out. Will Chipotle get to 450 in 8 days? Probably not. Could it get there in 36 days? Absolutely it could. So let's not play that game. You know, one of my mistakes from my youth was selling premium, out of the money premium, and it being too long. I got strikes I liked, but it was too long, and often those positions would come under pressure because the stock would move. The ability for a stock to predict a stock short term is easier. It's not even easy, but easier than it is longer term. The further you go out, the more variables, the more possibilities can happen. So let's be, you now add in more market risk, you add in more cases coming up. You know, think about it. Could there be more cases of whatever this is reported from Chipotle in 8 days or in 36 days? And if the stock sells off another $100, when is it more likely? When would be a better buy too? The answer is near dated. I like to sell near dated premium to buy longer dated premium. Do you recommend selling puts to go long, or do you recommend buying just calls? The answer to that is depends on the implied volatility. If you have 75 or 100% IV, I like selling some puts or put spreads, and I like selling those as far out of the money as possible. I usually like to go maybe 2 standard deviations or more out if possible. It depends. When you have high IV, you can do that. When IV is low, like it is right now, for example, in Facebook, I would prefer to play that via, if you want to play for long or you want to play for short, buy it with puts or calls. IV is low, your long premium. IV is high, your short premium. That is my experience with this. I assure you this is the correct way to do it. Anyhow, I think we got off a little bit further. I'm happy to do this. I know you guys like to talk about options. Someone was asking me about the best way to foray before. I promised I would get to that. Let's get to that now. The best way to foray into options is to keep it really simple. You can do covered calls, meaning you own the stock and you sell out of the money calls, and you could use that to generate income. That's good on certain stocks that are kind of in a sideways pattern, or if you have a lot of gains and you want to kind of book some of it or at least mitigate some of the risk. I like doing that. Or if you want to play directionally, it would be to buy a call. I don't usually like buying naked premium calls or puts. Once in a while, if I'm delta hedging or if I'm in real trouble on a position, I'll do that to kind of cut off my risk. I think I've detailed some plays that I've done that in the past. I did it with Priceline a while back, and I had some trouble once with LinkedIn. I had to do something. I was just rolling and giving myself some more time. Anyway, call spreads I like, buying a call and selling one still higher. What's good about that is that you don't have to worry as much about the implied volatility because you're short a call in presumably the same volatility, and you can and you benefit from the theta decay, so you don't have to be right the next day, for example. One thing I find that a lot of people make a mistake of is that they buy these weekly options. If you buy a weekly option, you are courting disaster unless you have direction and timing perfectly, because the theta decay, meaning the time decay, gets exponential every day. It keeps increasing. If you're further out, it's a little drip, and then it gets more toward the end, but at least you have more time. Often what I like doing is buying a longer dated call, for example, if I want to play long, and selling a weekly against it where I don't think where I know there's some resistance. So that way I could kind of pay down my longer premium and not have as much risk with the time risk. Because, the chances of the stock running X amount of dollars in, that same week is less than it is, like I said, in a month. If you want to play short, put spreads are really good. I often talk about put ratios. Like if I want to get, it's funny, I do put ratios when I want to get long something, but I want to catch some of the downside. Like I did this with Win yesterday on the big pop, the IV popped. I bought, it's actually down quite a bit. It was down $3.45. I actually thought that was going to be up or flat today. Well, I don't know if I'm going to have to do any adjustment on that. We'll have to see. I did a 65-62 put ratio where I bought 165 and I sold two 62s. That's roughly around where Steve Wynn did his buy. So I think that there should be some, I guess, price memory. I think this just ran too much yesterday. It was up like $10. Way too much too quickly, I think. But gun to head, I would say Wynn is probably, when the CEO buys 1 million shares, that's a lot. You know, he upped his stake from 10 to 11%, I think. That's a lot of money. So I would say Wynn kind of, maybe there's a floor in there. How do I know what? It was on the TV the other day. Excuse me. So that was Wynn. What else did I want to cover? There was something else. I forget what it was. Excuse me, I'm just choking here. It's tough talking without commercial breaks, you know? Oh, the transport. So the problem with the transports is they're heavily dependent on coal shipments. And as the price of coal is coming down and as President Obama starts banning coal, it's making it harder and harder for volume. So I think that's what's depressing the transports. I'm really curious to see how FedEx and UPS report, because this is supposedly the Amazon, holidays. If those are doing well, I would say that it is for sure the coal issue. I hate to say this time is different because it's never different, but I think that the energy as the decline in coal and the use of coal is what's really crippling, kind of handicapping those transports. I know the Dow theorists over there are probably going crazy on a comment about that. Excuse me. Oh, IBB. All right, so IBB, I talked about this the other day. We could be forming an inverse head and shoulders here, or we could be forming a bit of a double top. We're not going to know yet which it is. If you're long, or if you want to know if you should be going short, let's just use the 50-day moving average here as the barometer, is the pass don't pass line. And if you really want to go long, the only place I would use to add would be is if it could take out those double tops, which would be over 341.25 to 342.89. If you can get through there, I'll say that the worst of IBB might be over, and we could see 356 and 360 pretty quickly. That was really the big breakdown from the head and shoulders. There was a retest there already. We had now had a double bottom, and it's just been kind of consolidating and rallying. This is still a little bit of a bear flag to me. I like to see when trend and pattern changes, and we are now having higher lows. We just need that higher high, and the break of that double top, I would be looking to play it with a call spread. I'd probably buy the 341s or whatever, the 340s, and then sell the 360s against it or whatever, some type of combination. Maybe I would do a call ratio in that instance, like buy one and sell two. So that is my story with the IBB. IWM is showing a lot of relative weakness here. It's just hanging on by its fingernails to the breakdown range. Anything below 117.37 to me is a little vulnerable. I'm a little cautious with the IWM. It is kind of just in a consolidation range here. There's a gap fill around 110.63, at 110.63. So maybe do some put ratios with that. There'll probably be some responsive buying around those lows between like 107 and 110. So maybe structure it that way, where you buy something and then sell 2 times out of the money down there. I think we've covered a lot today. I mean, a real lot. This was really good stuff. I thank you guys for watching. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. If you missed any part of this and you want to see this again or catch up, and I'll be posting this on my YouTube channel. That's Justin Pulitzer Trades. Be sure to subscribe there. You'll get notifications when I post new videos. Periscope rebroadcasts, weekend review videos, and special edition videos. I have some really good ones cooked up for that. I just need to do it. I just need some time to do it. I'll probably, when everyone else is doing their Christmas stuff, I'll be recording, short selling videos and risk management videos. Anyhow, that's my story. I'm sticking to it. Let's have a good week. I'll be doing my next Periscope will be, I believe, I'll do it right after the Fed. I think the Fed day we'll do it. We'll do it the 16th. And we'll, of course, Sunday I'll have my weekend review video. Anyhow, let's have a good rest of our week, and cheers.